The financial world is a constant stream of breaking news and shifting events. A change in interest rates, a geopolitical shock, a new product announcement. Each headline can send ripples through the markets. But not every ripple affects every asset the same way. Some assets react sharply to certain events, while others barely budge. Understanding these different responses, which assets are sensitive to which events, is key to modeling financial markets. We'll learn how to connect the dots between events and the assets they impact. Natural groupings emerge, and we call these asset classes. An asset class is a group of investments that tend to behave similarly, respond to the same types of risks, and play similar roles in a portfolio. Here are the big six. Equities, investments tied to stocks, representing ownership in companies. Fixed income, instruments like bonds, where you lend money in return for future payments. Foreign exchange, FX, the relative value between currencies like the US dollar versus the euro. Commodities, physical goods like oil, gold, and wheat. Real estate, ownership of property and real estate funds. Cash or cash equivalents, holdings like money market funds used to park capital. To a quant, asset classes aren't labels, they're data structures built for analysis and prediction. To invest in an asset class, you don't need to buy the assets directly. You might want to invest in oil without storing barrels in your garage, or include hundreds of companies in your portfolio without buying every stock. In finance, we call this exposure. If your proxy investment responds to the same events that move the actual asset, we say it has exposure. You don't buy wheat directly, you can trade a wheat future that tracks it. You don't need to hold a basket of stocks, you can trade an index ETF that represents them. You don't have to buy Apple shares, you can trade call options on Apple. These financial instruments, futures, ETFs, and options, are only three of many types of investments that give you exposure to different assets. What matters isn't how the instrument is structured, what matters is which events affect it. For example, if the price of wheat goes up significantly because of a drought, the price of wheat futures should also increase. This is how quants connect models to markets. They study the asset class, then select instruments that give you exposure to its movements. Equities reflect ownership in a company, and with it, exposure to that company's future performance. A company's stock is ultimately tied to what it sells, how much it sells, and how efficiently it's run. New products can boost demand. Poor leadership can destroy value. Strong revenue growth usually lifts the stock, but shrinking profit margins can drag it back down. These signals often show up in quarterly earnings reports, revenue updates, and product launches, and markets respond immediately. To complicate matters, stock prices don't just follow company news, they also react to broader economic forces. A rise in interest rates makes borrowing more expensive, slowing investment and cutting into consumer spending. Rising unemployment can reduce demand across entire sectors. What's more, equities are sensitive to public sentiment. News cycles, investor narratives, even viral headlines, all of these can move prices, sometimes in ways that defy fundamentals. If you're the kind of person watching a video on asset classes, you're one of us. Join the Aspiring Quants mailing list. You'll get course updates, study tools, and first crack at new material. Bonds are loans. When you buy a bond, you're lending money to a government, a company, or a municipality in exchange for future payments. The main driver of bond prices is interest rates, and those are heavily influenced by central banks. When central banks raise rates, new bonds offer better returns, making older ones less attractive. Their prices fall. When rates are cut, existing bonds with higher yields become more valuable. Their prices rise. The second major factor is credit risk, the chance the borrower won't pay you back. U.S. Treasury bonds are considered extremely safe, but corporate bonds, especially from weaker companies, carry higher default risk. So investors will only make one of these riskier loans if the interest rates are higher. Once a bond is purchased, the deal is set. The borrower agrees to make fixed interest payments that can't be changed. But most bonds don't stay with their original buyer. They're traded on exchanges, where prices change based on what investors expect will happen next. Take inflation. If prices are rising quickly, the bond's future payments won't buy as much. The bond becomes less valuable, so its price falls. Or consider a recession. Investors might worry the borrower won't be able to repay. That increases credit risk and pushes the price of the bond down. But at the same time, recessions often lead central banks to cut interest rates. When rates fall, existing bonds with higher interest payments become more attractive, so their prices rise. This is why bond prices don't just reflect what's happening now, they reflect what the market expects in the future. The foreign exchange market, or FX, is the most liquid market in the world, trading well over $5 trillion a day. Unlike stocks or bonds, currencies trade in pairs. You're always buying one while selling another. You're exchanging currencies. The biggest drivers in FX are central bank policy, interest rate differences, and government manipulation. A central bank that raises interest rates makes its currency more attractive. Investors readily loan money to governments that will pay them more, but first they'll have to buy that currency to buy the bond, and that increased demand in turn strengthens the currency. Some governments don't let markets decide the exchange rate. Instead, they fix their currency to something stronger, usually the US dollar. This sometimes controversial practice is known as a peg. Why do this? Because a stable exchange rate makes trade and investment easier. Exporters know what they'll get paid. Foreign investors don't have to worry about surprise currency moves. But holding a peg takes work, and it can fail under pressure. In general, the biggest economies have the most widely traded currencies. This includes the US dollar, euro, yen, and pound. Like virtually all assets, commodity prices are driven by supply and demand. But unlike stocks or bonds, these are physical goods. They rely on planes, trains, trucks, and ships to move from place to place. Even small disruptions along the way can trigger outsized price swings. A drought can slash wheat harvests, spiking prices. Oil can surge on a single OPEC decision to pump less crude. Demand shifts too. Think of all the new factories gobbling up copper, or electric cars that require lithium for their batteries. Additionally, they don't generate income like stocks or bonds, so why include them in a portfolio at all? Some traders speculate on price moves, others use them to hedge risk. An airline might lock in fuel prices to avoid surprises. A farmer might sell crops in advance to secure income. Commodities are usually traded using futures contracts, agreements to buy or sell a specific amount at a set price and date. These contracts don't usually end in physical delivery. Most traders close their positions before expiration, locking in a profit or a loss without ever touching the goods. These are global high-volume markets. The most heavily traded commodities include crude oil, natural gas, gold, copper, and agricultural staples like corn, wheat, and soybeans. Quants aren't in the business of storing oil or shipping wheat. They trade the price because the commodities asset class is just another place to find patterns, place bets, and make money. Real estate is one of the oldest asset classes, one of the largest asset classes, and also one of the slowest asset classes. You're not trading in milliseconds, you're trading in neighborhoods. Prices move with interest rates, but also with regulations, zoning laws, and local demand. A city's growth can push prices up. Failing schools can pull them down. When interest rates go up and borrowing gets more expensive, fewer properties are sold and the whole market cools off. Although real estate transactions move at a glacial speed compared with, say, stocks, hedge funds and quants still trade this asset class. They use financial instruments like REITs, real estate ETFs, and mortgage-backed securities that track real estate markets without owning actual properties. Even in this familiar world of buying and selling property, quants still sift through the data, looking for signals others miss. Join the Socratica mailing list for aspiring quants. You'll receive materials, models, and have a front row seat to the full quant course.